everybody. Welcome to the How to Profit in Sustainability webinar. This is Paul Herman, CEO of HIP Investor. We have Tara Kelmain of SureGround Solutions and Chris Erickson of Climate Earth. Thanks very much for joining us today. We really appreciate it. We'll also be recording this webinar, and we have a lot of material to cover. However, we do want to make this highly interactive. So feel free to ask your questions in the chat log on the right-hand side of your screen, and we will dig in. So on today's webinar, both Tara and I will give an overview of the business value of profiting from sustainability and carbon-efficient supply chains. And then Chris Erickson will go in-depth on both the methodology and the tools that can help make your supply chain more carbon efficient. And along the way, feel free to use online chat. So just a quick overview. As many of you know, the concept of HIP is human impact and profit. It's the combination of doing good and making money, and by doing so, typically making more money. And when companies and processes and management practices are more hip, they are solving 5 human problems that result in a sustainable profit. And these 5 human problems include health and wealth, earth equality, and trust. And so the focus of today, as this series, is on the earth factor, and specifically on carbon neutrality and carbon efficiency, achieving carbon neutrality through carbon efficiency. And one of the drivers today for your business may include, if you're supplying Walmart, the sustainability index that's been pioneered by Walmart. HIP Investor has been involved in the design of this along with Blue Sky Consulting and nonprofits and academic experts. And though it has been pioneered by Walmart, it's now part of what's officially a sustainability consortium. So if you go to sustainabilityconsortium.com, you can see more information. And the 4 main categories of that sustainability index, which Walmart and other companies like P&G and Colgate-Palmolive will include energy and climate, material efficiency, natural resources, and people and community. And so the purpose of today's session is to dig in a little deeper into energy and climate so that you can be better positioned to sell to these larger companies or to deal with customer requirements that may come from a similar place. And these Earth indicators, which when Chris talks about Climate Earth and Climate Earth's expert carbon accounting system, by tracking the CO2, the carbon dioxide equivalent and greenhouse gas equivalent emissions, along with carbon reductions, energy efficiency, renewable power, and other Earth metrics, those translate into top-line revenue growth, which creates business value, of course, bottom line profit growth through cost reduction, tax optimizations, credits, incentives, depreciation, or some of the American Recovery Act incentives that are in place right now, including a 30% tax credit from the U.S. Treasury, and also for leading companies results in a higher price to earnings multiple. So there is financial value from becoming more carbon efficient. And so just quickly to take a temperature on where CFOs and investors are, McKinsey did a survey of 238 CFOs and investors and found that the vast majority of them, 85%, see long-term financial value from environmental initiatives, but that the economic crisis has led to much fewer of them seeing that these eco-initiatives are important. The challenge is that these are fast payback initiatives in many cases. And so Chris will talk about that in Climate Earth as to how it creates business value as well. And part 2 of the McKinsey survey, as we see on the next page, is that half of CSR professionals, corporate social responsibility professionals, don't know the shareholder value of their environmental and social initiatives, and that many of these professionals see charitable giving as a higher priority than revenue growth. So you see on this slide that McKinsey also did was an analysis of different initiatives that and how profitable they are. So efficiency in buildings and transportation and industrial processes can all be profitable in the short term. The longer term, in terms of some renewables and other innovations, will take some investment. And analysis that a HIP investor did, which was published in Fast Company magazine for about big oil, the top 10 energy companies, shows that at a $20 cost per ton of carbon and carbon equivalent, that the range of profit at risk can be anywhere from 8 to 19%. And True Cost has done this analysis across other sectors as well, including in the utility sector. Some utilities' profits could be wiped out if there's a higher price for carbon. So the price for carbon today, as you see on this slide, is down to about 10 cents on the Chicago Climate Exchange. That's of this end of day yesterday. And even though the regional greenhouse gas initiative in the Northeast among industrial and utility companies has boosted that up to just over $2, the European Climate Exchange is still having a price per ton in the 14 to 17 euro, depending on which vintage it is. So these prices also vary with the economy, and of course they will jump with any sort of policy initiatives that might come out of Copenhagen and specific national or regional frameworks. So that's the quick overview of the business value. What we find at HIP is that companies that aggressively and proactively manage their carbon efficiency and translate that into their management practices tend to outperform the S&P by about 4% on average. This HIP graph shows social measures, incorporates social measures as well as environmental measures, but the portfolio can be adapted for both. So on this next slide is just the mandatory financial disclosure about how that's calculated. You'll also find that on the HIP investor site. So I'm going to turn it over to Tara, and then Tara will turn it over to Chris.
Great. Thank you very much, Paul. Good morning and good afternoon, everyone. I'm Tara Kalmain at SureGround. I want to give you a little bit of information about what we do at SureGround. We really are focused on maximizing gain and good by working to develop profitable corporate strategies and partnerships that also solve global environmental and social issues. Our approach is really to develop multifaceted strategies, keep a holistic view, and create alignment rather than conflict in the metrics, and to maximize the multiplier effects where gain creates good, and good in turn creates gain. One of the projects that we're currently working on is an initiative to take a look at the CSR efforts of some of the world's largest companies to identify the leaders and the laggards in the good times gain equation. We'll take a quick look before we go to hear what Chris has to say at a couple of these two leaders that scored very well on the Carbon Disclosure Project 2009 report, both in the reporting and the performance. The reporting measure is one of how well they disclose the information and in what depth, but the performance measure is a new one that they piloted this year to take a look at how well they're doing against the actions that they had promised to take. So we'll take a look at what BASF and Boeing are doing. So at BASF, they take a look both at the gain and the good. The way that they talk about this is in value for BASF and value for society. In their case, innovation is really key, and they see a lot of opportunity in the climate change equation. When reporting to the CDP, the CDP questionnaire asks you to both take a look at risks from climate change as well as opportunity. And you can see here on this slide that the opportunity for BASF is very significant, that starting in 2015, they see between $2 and $4 billion in additional sales to be generated by innovations that address climate change. They also have a fairly significant 400 million euro investment in R&D related to climate change technologies. Some of the products that really drive both gain and good and have sort of a reinforcing effect are listed here. Insulation, often used in construction, is a product that not only saves energy once it's used, but it actually saves 3 times as much carbon than is required to make the product. They sold 400 metric tons of that and saved 110 million metric tons in CO2. Obviously, the more you sell, the more you save, so creating the gain times good equation. They also develop a resin that increases the productivity of wind turbines and are looking at carbon scrubbing as a future service that will help reduce 90% of greenhouse gases from coal-fired plants. So they're really doing quite a lot and doing well, I think, against the gain times good measurement. Another thing that they are doing is not just looking at the impact of carbon, but their idea of plant health and their product called Plant Health, is really the #1 corn and soybean crop protection in the U.S. is also increasing crop yield, which is supporting the sustainable food supply. So I think they're taking a very holistic view in what they're doing in gain times good.